Thank you very much, and good morning, everyone. It's fantastic to be here, and I'm really just going to take a few minutes to set the scene for what is going to be a really exciting panel to follow. What I want to do is really just highlight 5 themes, or trends, if you will, around what we're seeing in real estate. So now, these are not 5 positives or 5 negatives. Certainly not the only 5 trends or themes, but just 5 that we thought were sort of worth highlighting in the context of the discussion that's going to follow around, I guess you could sort of say, more institutionalizing the sector and creating exit opportunities and more liquidity through that space. So I'm going to dive straight into it in the interest of time. And the first theme I want to highlight is that infrastructure is really the new location. What do we mean by that? Well, infrastructure is the enabler of real estate, whether it's development or investment. Whether it's logistics corridors or urban real estate or even digital real estate like data centers. When we only saw the comments a couple of days ago around concerns around energy sort of availability for data centers, etc. And I think there is still a good story right now in terms of availability, but it certainly highlights the connectedness between infrastructure and real estate going forward. So where are we in this sort of space? And these are very big thematic macro kind of themes, so not necessarily very specific street corner ones, but nevertheless, the graph on your left sort of shows the infrastructure spend requirements, right? So the East Africa bar is relatively low, but when you look at it as a percentage of GDP, it's actually quite high, right? So by 2040, we need more of our GDP allocated to infrastructure. But where's the momentum and how's the trend doing? So if you look at the graph on the right, you can see that there is that upward trajectory. And look, this is across Africa, but sort of trending towards that kind of magic number of about $150 billion per year that should really be getting invested into infrastructure. So the gap is still there, and we need to do more and need to allocate more from a GDP perspective, but the momentum is still good. And certainly from a real estate perspective, you are going to see tailwinds arising from this increased infrastructure across the sector. And that leads me to the sort of second theme, right? And there's a few sub-themes within this one, but really it's around impact asset classes and their need to commercialize, right? So what do we mean by that? So I think the first graph doesn't need too much introduction. You're all aware of a lot of policy changes that happened last year, changes to USAID, closure there, and you can see the impact of donor funding 2023 versus 2025. And you can see that dramatic drop-off from the US, but you can also see the drop-off from a lot of other countries, right? And I think that's really what grabbed a lot of headlines. I think what grabbed less headlines is the sort of reallocation of that funding into more, let's say, investment and commercial sort of platforms, right? If you just take a US example, you only have to look at the sort of repromulgation of DFC in December last year for the next 5 years and a budget that's triple what they had for the prior 5 years. You just have to look at the mining indaba and the size of the delegations tripled or doubled in most cases for countries. So that spend and that focus is becoming more investment and commercial in orientation. So where does that leave us from a real estate perspective? But I think the one I want to talk to is the impact asset classes, the ones that are highly correlated with this demographic dividend story that we're undoubtedly sort of seeing. So whether it's housing or healthcare, student housing, etc. That aid funding or donor funding was never enough, right? If we took the 2023 peak year and assumed hypothetically, of course it could never happen, all of that was allocated to housing. That's roughly about 3% of that housing deficit, right? So the reality is that these asset classes need to commercialize as more and more sovereign funding adapts, but also commercial funding is going to be required. So that's theme 2. The third theme is really around pricing, right? And I think more this kind of pervasive sovereign risk layer that we see across real estate around the world, but that we sometimes sort of forget in an African context and kind of price it as more of a homogenous sort of story. So what I sort of looked to and used as a sort of proxy, and that's your your bar lines is the sort of Damodaran equity risk profile, so premium. What that is he's a professor at NYU, and every few months publishes an index and literally looks at what is the hurdle investors should be getting in a particular country to validate that risk. So he looks at sovereign bond yields, he looks at credit default swaps, puts it all together and comes up with an index. Now, I'd caution around using that as too much of a proxy for real estate, absolutely, because real estate, it's all about covenant, there's income growth on top of that, there's the ability to leverage, but directionally what it sort of shows us is this very disparate kind of range of sovereign risk sort of within the continent. And you can see how that kind of compares to sort of European markets, where I've also included a sort of prime kind of yield. And I think the key thing is to sort of really just highlight that kind of disparate range of lending, disparate range around sort of sovereign risk layer, which is quite closely kind of tied into this fourth theme, really. And that's just, well, what does this mean for real estate? And how does real estate compete? Because that's what it is. It's competition for capital. We're competing with real estate investors can invest abroad. They don't have to invest in Africa. They don't have to invest in this country. They can invest in a different country in Africa. And they certainly can invest in other asset classes. And that's really what we're going to sort of talk to in the sort of the panel, is that more institutional funding. If we just look at pension funds as a sort of good proxy for that institutional capital and unpack it a bit more. So there's roughly about $407 billion assets under management for pension funds, right? You can see how much of that is in South Africa. There's legacy and structural kind of reasons for that. And I think there's also a good amount of South African pension fund capital that has found its way outside of South Africa into real estate across Africa. But if we were to sort of exclude that South African number, what we'd see is the allocation is quite interesting. Roughly about 50% of that capital is allocated to bonds, right? Where globally you'd sort of see that at about 30%. So that over allocation, if you will, is typically the amount, the sort of capital that real estate would really be sort of looking to attract. Now, so the question is kind of why, right? I think the first thing is the yield story. So you can see that first column just around where 10-year government bond yields are, and they're attractive, right? And how that sort of even compares to that Damodaran equity risk sort of premium. But in particular, bonds, that's a very competitive alternative to real estate for any sort of institutional capital. So that's the one thing, is that there are good returns that are coming out of bonds, and there's questions around whether those are sort of, what are the fundamentals and reasons for that, which we can't necessarily influence all that much, but we need to make sure real estate is competitive against that backdrop. The final theme before I call up my panel is just around, well, if it's not only about pricing and competitive with other sort of alternatives, are the platforms there? Are there sort of sufficient platforms? Because what's worth highlighting from the previous slide is the actual allocation from pension funds into direct property is slightly higher, is a bit higher than global sort of averages. Now, that's obviously where pension funds are investing actually into the real estate and the assets themselves. It's still a relatively small portion of their overall sort of allocations, but it's slightly higher than that kind of global sort of average. So typically they should be looking at platforms, whether they're listed or unlisted. But what I've highlighted here is more just the listed sort of story. You can see that of 1,141 listed companies in Africa, only about 44 are pure real estate vehicles, whether they're REITs or real estate income sort of funds. A lot of those other companies, of course, own real estate and, of course, are sort of important in their broader ecosystem, but it's still a relatively small amount. But I think it's a nascent sector. I think from 2013, when you sort of saw the REIT promulgation in South Africa, you've seen good momentum, and we're seeing momentum in his announcement, which we'll talk about just this week. But it's been slow. And I think that the discussion today will follow from these 5 themes to kind of say, how do we create more of these vehicles to create exit opportunities to kind of move some of that capital that's there. It just needs a thesis and a home. So with that, I'd like to call up my panel. Yeah, thanks.